Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On today's show, a nearly $3 billion deal to take Utz Brands private is in the bag. We're going to tell you what this means for some of America's favorite snacks. And the major deal between Paramount and Warner Brothers is now on pause. The legal holdup could cost Paramount Skydance billions. And moments from now, we're going to hear from THL Partners co-CEO Scott Sperling, his take on what investors need to know as hyperscalers report earnings and give guidance on AI build-outs. For today's big deals, let's start up with the holdup in Hollywood. Paramount Skydance was just on the brink of closing its blockbuster $110 billion takeover of Warner Brothers Discovery. Now a federal judge has temporarily paused the deal, saying it likely violates antitrust deals. And here with me is Bloomberg senior deals reporter Michelle Davis. I mean, Michelle, was this a surprise? I know the states had sued trying to block it. Is it a surprise that the judge has now put this on ice?
So it's definitely unprecedented. It's rare to see states and courts rule against something that federal regulators have already cleared. But it is a quick victory for the states here. But at the end of the day, it's only a 14-day pause. It's not a death knell for Paramount. They weren't actually going to close their deal in the next 2 weeks. They're still waiting on UK and EU regulatory clearance. But it is an indication that this judge basically said, you know, states, I think you guys have an interesting argument here. It's compelling. And over the next 2 weeks, both sides are going to be submitting briefs and really getting their arguments ready to provide a fulsome defense or argument for why this deal should or shouldn't happen. And the real key date to watch is going to be August 3rd, because that's when the judge is going to decide, do I pause this until a bigger trial can happen next year? Do I toss the case out? And if she does pause it until a trial next year, then it gets really, really expensive for Paramount, because they have to pay $650 million in ticking fees for every quarter that it doesn't close after September. If you assume that the trial is going to be in August, which is when the states have asked for it to be scheduled, that amounts to almost $2 billion if you have to wait till then.
Is there also something to be said about deal making beyond Paramount, the regulatory environment? Is this a very Paramount, Warner Brothers specific pushback from the states, or are we seeing states just being much more active and forceful when federal regulators have maybe allowed more deals than usual to go through?
We've definitely seen the states testing the limits of their authority here. And, the big theme over the past few years, especially since President Trump came in for his second term, is that companies have been attempting all the deals that they didn't think were possible before, big railroad mergers, this big media consolidation. And so far, nothing's really tested that. But if this case does get held up in court, it could have chilling effects across the industry, especially with the midterms coming up. It's not like we'll see any change necessarily among FTC and DOJ regulators themselves, but if there's just more scrutiny and legislators with subpoena power bringing more attention to deals that they think are not competitive, then we could see states continue to try to hold these deals up, and that could make companies just less likely to try these big splashy deals.
Right. I just think about how painful it is. I mean, bringing it back to Paramount, didn't Paramount promise a much bigger breakup fee? And I wonder how much of that was confidence that this would get through regulators, because it's much more than Netflix paid, right? So now all of a sudden they're on the line not just for the ticking fee, but should this not go through? I mean, Larry Ellison's going to have a pretty big bill coming his way.
Yeah, it's a $7 or $8 billion breakup fee that they have to pay if this deal gets blocked by regulators. And when they agreed to that, they were obviously very confident that this deal would get through. It was a curveball, that the fact that the states came in with this lawsuit, and that the judge has given them the time of day and allowed for this argument to further be developed. So it'll be interesting to see how long Paramount actually fights for this, because the longer it goes, the more costly it's going to get for them. The longer it's in limbo, just the harder it's going to be for them to justify doing this deal. There's a chance they could even, walk away if it turns out that it's going to be too costly.
This has been so interesting, and we've loved following this deal with you, Michelle. Thank you so much. That's Michelle Davis from our Bloomberg Deals team. For employees at Paramount Skydance and Warner Brothers Discovery, the fear that a merger will lead to mass payoffs is perhaps real, given what just happened at another media giant. Scarlet has more on Disney. Scarlet.
That's right, Danny. Disney's ESPN this week began a round of layoffs tied to its takeover of the NFL Network and the league's other media assets last year. According to a staff memo, ESPN chairman Jimmy Pitaro said that the sports broadcaster and streamer has made significant progress integrating these NFL assets, and that throughout this process, they've evaluated teams, resources, and organizational structure, resulting in what he calls job impacts. The memo did not specify the number of job cuts, but we know some high-profile staffers were affected, including on-air analyst Ryan Clark, formerly of the Pittsburgh Steelers, and Carl Ravitch, a 33-year veteran of ESPN who handled play-by-play coverage of baseball and college basketball. Both of them were let go. And it's not just ESPN either. Disney announced layoffs at its other divisions, including Pixar Animation Studios, home to the Toy Story franchise, as well as National Geographic. Remember, ESPN's purchase of the NFL Network was worth some $2 to $3 billion, in contrast to the $110 billion Paramount Warner Brothers deal you were just talking about, which, as we know, state regulators fear will lead to much more extensive job cuts.
And I know one producer, Tim, is just devastated by the layoffs of ESPN talent. Scarlet, thank you very much for joining us. Also in the deal-making headlines, Utz Brands has agreed to be taken private in a $2.9 billion deal with Intersnack, giving the European snacking powerhouse its first foothold in the U.S. market. For more on this, we're joined by Bloomberg Intelligence analyst Jibril Lawal, and Bloomberg's Bailey Lipschultz is here to discuss another foods deal that is Jersey Mike's. Let's start with Utz. You point out that this was a 91% premium. That feels kind of insane for a snacking brand. What made this for Intersnack so attractive and so willing for them to pay up?
Well, yes, I see this as a geographic expansion play, right? Intersnacks is a business that's heavily concentrated in Europe as well as Oceania. But what it does is it offers the opportunity for it to expand into the U.S., right? Right now, Utz holds about a 4% share of the $37 billion U.S. salty snacks market, and it has brands like Zapp, Utz, Boulder Canyon, as well as its long manufacturing footprint, its diverse and hybrid distribution model, as well as expanding penetration in core region, in regions outside of its core Northeast region. Should allow for it to continue to expand.
So it's clear why that would be attractive for Intersnack, but I wonder about the wider ecosystem. To you, is this a signal that we could see more deals down the pike in snacking, in foods and packaged items?
Yes, so what I would say is I don't think this deal was done in isolation, right? We saw Mars acquire Kellanova late last year. We saw Treehouse get taken private by Invest Industrials, and now we have this, right? But what I would say, quite frankly, is that the packaged food industry has been going through a period of kind of slower organic sales growth, and that's primarily because of consumers, budget-strapped consumers, who they're not purchasing as much, or they're being more selective with their purchasing. So now, naturally, what is an alternative strategic growth lever? That's M&A. So we like to see, I expect more consolidation and the potential for bolt-on acquisitions for these companies as they start to look for that next start or that kickstart of growth.
It's so interesting you say this idea that consumers are getting more selective, because within that ecosystem, Bailey, we have Jersey Mike's becoming public. And this, of course, is a Blackstone-backed company. It's something that they've held, we've discussed this before, a little under 2 years.
We closed it in January of 2026.
Okay. So they haven't held it for that long. They're confident they can IPO this thing. What are we looking at, again, just given the environment we were just talking about?
Well, the interesting thing is we've seen Kava, we've seen Sweetgreen sell off recently because of the pushback and the issues with lettuce. So that's kind of top of mind when I'm talking to folks on the buy side. The big question comes back to valuation. They're targeting about an $8 billion valuation at the top end of that range, raising $1.1 billion. Jersey Mike's selling some of that, but as is Blackstone. The big question going forward is how much do investors want to buy into the management team, former CEO of Wingstop leading the charge there, and this idea of international expansion. They brought back the founder, of Jersey Mike's to lead an operation in the UK. So the big question going forward is how much do investors want to underwrite the US and Canada business right now as it is, and how much are they buying into the dream of international expansion?
Well, one of the reasons that this IPO is so exciting is that it's not AI. It feels rare, barely, but I wonder how rare it actually is, or if it's just like the big splashy AI companies have been getting the headlines, and there actually are consumer brands willing to go public right now.
I would say top of the head, about 80% of deals this year from IPOs in the US have been AI or AI adjacent. Wow. So whether you're powering it or you're a chip maker like Cerebras, not a chip maker like Utz, but the big question now, got him. But the big question though gets back to how much do investors believe in consumer? We've seen biotech deals trade pretty darn well, and we do have a number of those companies kind of circling the hoop. So when you look at what the July and August window looks like, less AI, more either biotech or consumer goods.
All right, thank you both so much for joining chips and other kinds of chips and sandwiches. That's Bloomberg's Bailey Lipschultz and Bloomberg Intelligence's Jibril Lawal. Coming up, we're going to talk tech and private equity. THL Partners co-CEO Scott Sperling will be joining us shortly. This is Bloomberg Deals. Tech giants Alphabet, Tesla, Intel, and IBM reporting earnings this week. What will the companies say will be a factor, though, beyond public markets? And that brings us to our alternative view, where we look at the latest trends in private assets. So pleased to say we are joined by Scott Sperling, co-CEO of THL Partners. In its history, it has deployed more than $50 billion in equity capital, and they recently just closed its $6.4 billion 10th fund, which will aim to capitalize on AI and other tech. So, Scott, you are the perfect person to speak to at this moment, because there has been this whole narrative. What Alphabet says about CapEx, what the other hyperscalers say, it is important for the entirety of the AI and tech ecosystem. How are you thinking about that, given your current investments and future investments in the AI ecosystem?
Sure. We look at AI as a long-term secular trend of unprecedented power. What happens over a quarter-to-quarter basis in terms of the expenditures of the hyperscalers on that technology probably isn't as crucially important to us as a middle market growth investor in private equity. But what we believe is that the trend towards the utilization of artificial intelligence to improve almost every aspect of almost every business that we look at in one way or another, whether it's revenue generation or the productivity and efficiency of its business model, is what's really crucially important. And I think we are continually surprised by the power of what we're seeing produced, not just by the large language model companies, the frontier model companies, but in a number of areas where you're utilizing generative AI in ways that are doing things that one may not have thought was possible. So technologies that allow it to be more deterministic, technologies that allow you to implement revenue growth strategies and productivity strategies at costs that are remarkably acceptable in a world of token maximizing that we haven't seen before. So there are constantly twists and turns here. The dynamics are obviously incredibly high right now. So one has to be careful when you're investing in companies as to whether or not AI is going to be a friend or a foe.
Well,
and I think everyone in our industry really looks at it that way.
I also just wonder, as you're looking at the various investments, if there's any echo to software in a post-pandemic atmosphere. And what I kind of mean is we decided, or the private equity industry decided, that after the pandemic, software was really attractive in a world that was really turned on its head. At the moment, we've rethought software. We're rethinking a lot of things. Might we be making some of the same mistakes with AI? Like, are valuations getting a little frothy? Because at the moment, this just seems like such a safe sector.
Well, I do think that as we look at investments in companies that will utilize AI, one has to look at the underlying model of those particular businesses and have some assessment of how AI might actually modify that, hopefully to the good. I think if you look at software companies writ large and the SaaS apocalypse, however you actually say that, I think that there were a lot of software companies bought at prices that relied on the certainty of the revenue streams attached to those business models. And in many ways, that certainty is now gone. And so you're seeing an adjustment mostly in the multiples because the business performance of many of those companies hasn't been adversely affected yet. But you're looking at lots of questions about the long-term certainty of revenue streams that affect very specific software companies. And there's others where the nature of the data that they have and what they enable companies to do can be enhanced by the incorporation of artificial intelligence into their core products. So one has to be really careful. This is much more of a stock pickers market than it is a market where you can make very broad generalizations and sweeps.
Scott, I would also love to talk about the credit side of the equation, especially as rates stay elevated. We're worried about inflation and whether the Fed is going to be able to cut. Every now and then you do see some pockets of stress in highly levered deals. There have been some reports that Fortna, your e-commerce supply chain automation company, is having some liquidity issues, and you're looking to lenders for a lifeline. Well, what is the latest on that?
So hard to talk about a specific company that's in the middle of discussions at this point in time. But I would say generically what we're going to find is that there will be discussions with not just private credit, but with banks and other cases for companies in the industry. You've seen a number of situations across the broader private equity industry where you've had to have conversations that lead to outcomes where the creditors end up owning a large part of the company, and the company continues to go on and is recapitalized in ways that I think are positive for the majority of stakeholders. And I think that everyone, at least in our very limited experience, thankfully, in this sort of thing, tends to want to move to a very productive outcome.
It just reminds me, because I spoke with Orlando Bravo shortly before they handed over the keys to Medallia, and he basically said, look, we're done injecting more equity into this company. We don't want to throw good money after bad. At what point, just thinking broadly here, do you make that decision? Do you say, okay, the investment thesis has changed, we're okay to kind of back off from that company? What is kind of the threshold when you start to make that decision?
I think we constantly evaluate how we can help a company perform better operationally and look at what the nature of the payoff is as we put that effort into these companies. And so it's a constant reevaluation when you're off a business plan as to what you need to do to get back on track and what the payoff is for you as an equity investor in those companies.
I also know you've noted that oil price-driven inflation is not an insignificant risk. Just looking at public equities, your, shall we say, less intelligent, more reactive counterpart to private equity, they haven't really been reacting. It feels like we're not pricing a lot of risk in. How are you thinking about the risk of higher oil prices, more inflation, given disruption continues in the Middle East?
I think I'm of the mind that it will be better to suffer some short-term pain and have a longer-term, more stable situation. We know that these things are cyclical. There are lots of reasons why commodity prices go up and down. It's obviously painful to many people when you have inflation in such a key part of one's budget as energy prices. I think in the United States, we benefit from the fact that we have excess of natural gas, which is the most important fuel for powering electricity and powering people's homes. Obviously, gasoline prices are affected, but not just by the overall price of a barrel of oil, but also by the regulatory environment that has led to a very tight refining capacity situation. So, my hope is that, we're going to come to a much better long-term outcome with what we're doing in the Middle East.
Right.
And that will lead to the expectation that inflation will actually be lower going into the future. And certainly for the United States, given how much energy we supply,
Scott,
both domestically and to the world, I think that's a big positive.
I just wanted to jump in, because I've only got 30 seconds here, and I don't mean to rush you, but just very quickly, is it a problem for this industry if we don't get rate cuts, considering there has been still a slow unthawing of deal activity?
Nope. I've been doing this for almost 45 years. For much of that period, rates were dramatically higher than they are today. I think what happens is you have to adjust the entry prices as you go in. It may have an impact on exit multiples, but we are not in any shape or form at levels of interest rates that would be highly problematic on a secular basis for our industry or the economy.
Scott, so fantastic to catch up with you. We're going to have to do it in person next time. Scott Sperling, co-CEO of THL Partners. Coming up this year at the annual Farnborough International Air Show, defense and aerospace deals taking off. We'll have that next. This is Bloomberg Deals. This week is the Farnborough International Air Show in the UK, where leaders in aerospace and defense showcase their advancements. Deals also flying. This year's show also comes amid a backdrop of wars that are putting upward pressure on oil prices. Airbus CEO spoke to Bloomberg about deal making.
We still see a very strong demand for our products. We have a backlog of more than 9,200 aircraft, and we continue to get fresh orders for our short-distance aircraft, for the long-range aircraft. The Middle East crisis is actually fueling some demand because price of oil is very high, and fuel-efficient aircraft are in more demand.
Bloomberg Sid Philip was at the air show. He joins us now live from London. We're missing you here in New York, Sid, but great to talk to you off the back of this air show. I wonder, let's just start with deals among consumer-oriented plane makers. What sort of things did Airbus, Boeings of the world, what sort of orders did they receive?
So, Danny, the commercial aircraft orders were pretty subdued at this Farnborough Air Show. We saw an order for 200 narrow-body aircraft from Jet Lessor SMBC. That was 100 Airbus planes and 100 Boeing planes. We also saw smaller deals for 15 aircraft from AerCap. We saw deals from airlines like Philippines Air looking to order some more wide-body aircraft. But overall, the sort of deal-making for commercial aircraft was pretty subdued. And that's largely because one, aircraft are very sort of back-ordered until the beginning of next decade. And the second sort of reason why is because airlines are still sort of watching from the sidelines to see what happens with oil prices and whether they deploy the capital towards actually sort of funding their operations rather than buying expensive jets at the moment.
Forgive the cliche, but I guess it's, a double-sided coin. On one hand, higher oil prices mean stress for consumer, but those higher oil prices that are happening because of geopolitical turmoil and wars, and specifically a war in the Middle East. Did we see a lot of defense-related deals get struck?
Absolutely. I mean, we saw lots of defense-related products being showcased at the show. So we saw Boeing's MQ-28 Ghost Bat, which is, they call it sort of a collaborative combat aircraft. Essentially, it's an autonomous drone that accompanies stealth fighters. We also saw Anduril showing off their tilt-rotor combative aircraft, which is basically a drone that can accompany attack helicopters. So we did see a lot of deals on the defense side. We saw a lot of technology being showcased. Autonomous drones were a big highlight of the show, and also the conventional fighter jets.
Yeah, really interesting to see all of that technology and deals. Bloomberg Chief Aviation and Transportation Correspondent Sid Philip, thank you very much. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Scarlet Fu, who's been taking a look at the setup for activist investors in the second half of this year. Scarlet.
That's right, Danny. Activist investors looked past volatile markets and geopolitical risks, embarking on a record number of campaigns in the first 6 months of the year. According to Lazard, Activism was up 20% year over year to 184 campaigns. That's that yellow bar. That represents a 38% increase over the 5-year average. When you break it down, the U.S. and Asia, in particular Japan, saw the most action, while Europe, the blue slice there, saw a decline in activity. And what exactly were these activists seeking? The usual M&A and board changes, along with capital allocation demands. But interestingly, artificial intelligence also starting to become a theme. For instance, Elliott Investment Management has been pushing London Stock Exchange to speed up its deployment of AI across its platform to narrow a valuation gap with its U.S. peers. And more recently, Bloomberg learned that Elliott built up a large stake in car insurance software provider CCC Intelligent Solutions. Taking a step back, globally, tech is the most actively targeted sector after industrials. Danny?
Scarlet, thank you very much for that setup. A perfect setup for this week's investment committee, where we bring you into the boardroom debates in real time. Today's IC on activism, and our IC members, Carmen Lu, she's a partner at Paul Weiss, and Shaun Mathew, partner and head of shareholder activism and hostile takeover defense at Kirkland and Ellis, two of the most busy people on Wall Street, just given what Scarlet just mentioned. Carmen, can I start with you? Where are you seeing the bulk of activist interest right now? What type of companies or what sectors?
I mean, activists are looking for a specific type of company, and it really falls into three key criteria. Number one, you've got to be a fundamentally good business. Number two, you've got to be undervalued. And number three, and this is really important, you've got to be a company where the fix can be near term and is pretty clear. So where we're seeing all the activity, I think the data speaks for itself. We're seeing it really concentrated within the technology and industrial sector. It's not because of the sectors themselves in particular, but because in those sectors, there's a disproportionate number of companies that fit the criteria of targets that activists like to seek.
Would you agree, Shaun? It's not necessarily the sector, it's just it so happens that they kind of have that criteria that makes sense for activists.
Yeah, it's people focus on vulnerability to activism, but as Carmen said, there's got to be a way for the activists to make money. And we're also just coming off a record first half of the year in terms of the M&A market. Guess what? The number one platform for activists is push the company to sell itself, and so not surprising that has driven the demand for activism.
By the way, we have just seen a lot of volatility within single name stocks themselves. I mean, like IBM can sell off 22% in one day on a small release. Shaun, does that increase activism, or does it make them a little wary when the stock is so volatile to really jump in?
Well, yeah, we're spending a lot of time with clients facing what we'd call a very jittery market. So, whether it's a big miss or even the slightest of misses on earnings, you're seeing massive swings in stock prices. So that makes companies feel vulnerable. Like, no doubt, activism is just one piece of the vulnerability puzzle there. But I think the question for the activist, investor would be, yeah, they're vulnerable, they're cheap, I can buy a big stake, but can I make money? And is this a falling knife? Is this a permanent re-rate of the stock, or do I actually have a lever to make money? And when we're spending time with clients trying to help them prepare for this, that's the main area of focus. It's like, how do you anticipate those arguments and be ready if they throw that in your face?
I'm guessing you've had similar conversations with clients, Carmen. And I'd have to imagine, has that been happening a lot in software, like among software clients who've seen their stock fall 20%? And yes, an activist could come in, but maybe it's a falling knife?
Yeah, absolutely. I think this is a really great question. I mean, we've been seeing this across sectors, but I think it is concentrated in the SaaS sector in particular. This has been going on for several months. And to Troy's point, just because a company is cheap doesn't necessarily mean it's a good activist target. The activist needs to find a pathway to create returns and create returns in the near term. So an activist is going to be looking at, are there fixes? Are there capital allocation fixes? Are there ways to streamline the portfolio? I think, the issue for certain companies right now is activists don't know. There's too much uncertainty in the markets. So activists don't know whether to jump in or not. So just because a stock is cheap, it may increase vulnerability and create opportunities, but doesn't necessarily guarantee an activism campaign.
In looking through some of the numbers that Scarlet had, so first half, really big year, but proxy fights was still incredibly limited. The ratio is completely out of whack. I think it's something like nearly 200 campaigns, but only 3 proxy fights? Carmen, that seems very odd to me. What is that? Is it just activists just straight out don't want a proxy fight, or are these companies that are just rolling over, handing the keys to the kingdom, also hoping to avoid a proxy fight?
I think it's somewhere in between. I think the tactics have definitely shifted. One of the key things I think we need to bear in mind is proxy fights are expensive. And expensive for both companies and for the activist. And I think a lot of companies, well-advised boards, and activists who become more sophisticated are realizing, well, why run a multi-million-dollar campaign when you could probably get more done by having a constructive conversation with boards who typically, more so than ever before, are more open to at least listening to the ideas activists have to present.
Well, Shaun, I know when we had talked in April, you said something similar, like too many companies are capitulating. Did they hear your calls maybe to put up a bigger defense?
Yeah, look, I wouldn't read too much into the low numbers there. I think the number, as you saw, of actual activist campaigns remains at record highs. Just because there are fewer fights doesn't mean Carmen and I are both extremely busy fighting these off in the background. And I think also the prevalence of the M&A demand doesn't really lend itself as much to a fight, right? If an activist, their biggest lever is public pressure. It's not like their goal in life is not to run a proxy fight, win a proxy fight, get on the board. Their goal is to make money. And I think what we've seen is they've been effective using that leverage in different ways. So I don't no board member watching this, I think, should take comfort from that low number, unfortunately.
Would you have the same message to the boardroom, Carmen?
I think boards are so well advised today for the most part. They understand that it is valuable to hear what their shareholders think about the company, and that includes activist investors. I think boards are willing to listen, and that leads to constructive engagement. But I wouldn't say, I think the number of proxy fights doesn't necessarily mean that activists are stepping back and they've grown soft.
Carmen, I also I saw you flag this really big uptick in financials being an activism target. What's going on there?
I mean, I think it goes to my earlier point about activists looking for kind of companies that fit a certain set of criteria. And I think when you look at the financial sector, there are certain companies that do fit this target that is very suitable for activists. What does that mean? You've got companies that their valuations have relatively stagnated. You've got financial companies where they're kind of a collection of different businesses that could be ripe for simplification. And then you've also got a lot of banks and similar companies in the financial sector where there's got a lot of cash on the books. And that creates an opportunity for better capital allocation, potential returning capital to investors. That gives an activist a lot of different levers to generate returns, and I think that's why we're seeing a concentration of activity in the financial services
sector. Are you
sector.
seeing something similar, like a big uptick in that sector?
Yeah, I think behind tech and industrials, the financial, and it's been driven by one or two hedge funds going after a lot of bank holding companies. So I think that the sort of persistence of those funds has sort of driven these numbers over the last year.
I just wonder, when it comes to transformation, to squeeze out a profit. You could say this among banks, you could say it among other firms, but Shaun, when activists come in, I wonder how they're approaching AI. Is it AI can come in and make this company a lot more productive, or is it like use this AI and then you can fire some people? And that's a great way also to squeeze profit out. Like, how much of it is transformational, just kind of chipping away at the edges?
So I think activists are not experts in AI. They are generally experts in financial engineering, in capital allocation, things of that, and pushing companies to sell themselves. It doesn't stop them from making operational suggestions over the course of the history of activism. AI is no different in that regard. And I think, Danny, it's both. It's like in some companies, in large companies, you've seen them push for, utilize AI, push for significant rifts. It could be you're not using AI, you should invest in AI and have a better strategy. Really, it's just a powerful suggestion. It's the flavor of the month, and companies are going to have to react and be prepared.
Yeah, Carmen?
Yeah, I agree with Shaun. I would also add, we've had such a run-up in stocks in companies that have said we've got a grand AI strategy. I think we're moving from an era of AI ambition to AI accountability. And what does that mean? I mean, with all this AI spend, I think one of the questions activist investors may be having for companies is, what's the ROI? Because if you're an activist investor, you're looking at every single dollar that the company is investing and saying, is this dollar better invested in AI, or is this dollar better done returned to shareholders? And I think that's the calculus that I think companies need to be aware of when dealing with AI as an activist theme.
So only a couple minutes here, but I'd love to just end with us all dusting off our crystal balls. So obviously very active first half. Shaun, what are you expecting for the second half of this year?
I think probably one of the busiest activist seasons going forward. I think the AI trend will only continue. And again, I think the push is going to be activists saying, look, we can help you, company, communicate better. We're an AI winner, not an AI loser. And if not, we're going to go after the CEO, which is another trend we've seen, really drive activism over the last few years.
I mean, same thing. Second half, more of the same of the first, just very active.
I think it's really busy. I mean, when I talk to clients, I say, think about the activism landscape as an iceberg. You may not see a huge amount of activity happening above the surface, but there's plenty of activity happening below the surface. And given all the backdrop, the structural backdrop, the AI trends that we're seeing, I think there's just going to be more opportunities for activists to approach companies.
So no summer vacations
is
kind of what I'm hearing. Thank you both so much for taking the time to join me. Such a pleasure to speak to you both. That's today's Investment Committee, Carmen Lu with Paul Weiss and Shaun Mathew at Kirkland and Ellis. Up next, another AI IPO is on the horizon, but this time in China. We're going to have more on IPOs and tech next. This is Bloomberg Deals. You're watching Bloomberg Deals. I'm Danny Berger. Everyone's hyped about a giant IPO and in the U.S., many of them to come. But China has its own coming later this year. Moonshot AI is preparing to discuss or least is in discussions, in August on a final round of fundraising before finally listing in Hong Kong at a valuation at as much as $50 billion. Joining me now is Jamie Turturici, head of TMT Equity Capital Markets at Barclays, which advises businesses on IPOs, everything from Cerebus to SpaceX. So you've had a lot on your plate as of late. Jamie, I think in this moment, this is a market that was feeling the nerves of the success of Chinese open source models. And I wonder, what does it do to a lot of the companies that you're speaking with looking to IPO when you have not only that threat, but also those companies going public in Asia?
Sure. Well, you know, there's a great deal of anticipation about all of the LLM opportunities coming to market. And when I talk to investors and I get a sense of where they are focused, they're very much focused on the opportunity of AI and where basically all of these hyperscalers and the models are really chasing demand that's already there. And so I think there's going to be a market opportunity for several opportunities out there in the market as we go forward.
I mean, the pipeline looks really robust. Everything from Anthropic, OpenAI, maybe we don't get that this year, but even so, where are we in the cycle? And can we even call it a cycle right now? Or is this kind of like a one-off with all these giants just rushing to market?
Yeah, we can call it a cycle. Historically, when you look at these IPO cycles, they tend to last 5 to 6 years once you get that first up year from the trough. That would put us in about year 3 right now. We had 16 tech IPOs last year. We're at 8 so far this year. I think in all likelihood, we have the highest mandated pipeline we've had in over 6 years. I think that actually we will likely exceed last year, certainly much higher on volume. And the breadth of that pipeline is the best I've seen in my career.
Really? Because one would assume that it's just like all AI companies. So what exactly does the breadth look like? How many are AI adjacent, or even things like software maybe?
Look, I would go as far as to say we're on the verge of a golden age of innovation. When I look at the pipeline, it's not just AI LLM companies, but you have the power, you have compute, you have the data center and infrastructure around that. You're going to have actually application software as a part as well. And then you go a layer lower, it's robotics, automation. Those are actually opportunities as an offshoot of that. And then we have areas like defense tech and space, which are huge opportunities the next couple of years. Blockchain, quantum. I mean, it's in my career, I haven't seen this many innovation cycles actually happening all at the same time like this in the past.
Are investors well enough received to that it's not just the golden age of innovation, but it also means it's the golden age for tech IPOs?
Yeah, I believe so. I mean, the reality is there's a scarcity of growth in the public markets. If you look at how many tech companies are growing at least 30% in the market and expected to grow 25% this year, out of all 6,175 US listed companies, all of 17 are growing at that rate. So the reality is the IPO pipeline will actually fill a lot of that gap. There's a lot of anticipation for high growth to come.
See, that's really interesting because there also has been this narrative that's maybe a bit orthogonal to that. And it goes something like not even just a scarcity of growth, but just scarcity of public equities, scarcity of tech companies, as so many of them have been able to remain private for longer. Is there a fear that that switches when you do get a lot of supply coming on, that the market won't be able to absorb the level of supply that we're expecting?
Yeah, it's a topical question for sure. We believe that there's plenty of capacity in the market to absorb these, and there's a few reasons why. Number one, if you look at the global equity market cap, we're up to 165 trillion. Last time we had an IPO peak in 2021, that was 120 trillion. So we're up 40% in that respect. If you look at the average daily trading volume in the markets, it's about 140% higher than what it was at that time. And you have $8.3 trillion in money market funds on the sidelines. That was 5 back then.
Guys, how competitive are these bake-offs right now? I know something like a SpaceX, it's huge, so it has, you, Morgan Stanley, Goldman, they all come together. But these other deals that you're in the market for, are they more competitive than usual just because of the attractiveness of some of these companies?
Oh, it's always been a competitive market, right, on the book runner front. I mean, I think that's where real judgment and advice matters in picking book runners. But of course, it's competitive, and there's more and more companies that are exciting that we're going to bring to market.
By the way, has it changed anything? So I think a lot of people were very excited about SpaceX coming to market, the biggest ever IPO, and then it opens up the doors for everyone else to follow an IPO. Does it make a difference at all when you see SpaceX trading below their IPO price? Does that in turn give anyone cold feet when you see some of the price action?
Yeah, not necessarily. I mean, there's so much excitement around what's to come, and you're not likely to get more tech IPOs until about the September timeframe anyway. So there's time, and there's in the very short term, in this month we've seen high momentum as a factor retrace, right? That was after the best, basically first half that it's actually ever had in history. And so there's a little bit of give and take in the short term, but there's such a pent-up demand for these private companies that are doing well that we think will be public companies. I don't see that necessarily getting in the way.
Can software companies still come public in this environment?
Sure.
Do you have any in the pipeline?
We do. Look, I do think there's a burden of proof on software to prove either that you have an AI tailwind that's showing up in the numbers, or that you have a defensible business with a good competitive moat to that AI threat. That's absolutely needed to come public right now. But we do see opportunities in software in multiple different areas. You've actually seen too, into April, it was a monolithic sell-off in software companies on the AI threat. You're now actually starting to see investors really parse the waters there and say, okay, well, if you're a cyber security company or if you're infrastructure software, you might actually have nice tailwinds from AI. And so we're at the point now where the market is starting to delineate between those two things. And there's definitely opportunity.
We're just out of time. I wish we had more. Thank you so much for joining. A real pleasure to have you on this. Jamie Turturici of TMT Equity Capital Markets at Barclays. Coming up, the owners of Liverpool FC are considering selling a stake to a consortium of investors. More on that coming up next. You're watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger alongside Scarlet Fu. And Scar, some deal news from this week that we've been watching.
Yeah, first up is Mavis Tire Express Services has agreed to acquire Pep Boys from Icon Enterprises for around $700 million in cash. The deal is expected to close in the coming months. Icon will retain Pep Boys' owned real estate, Amco Transmissions, and Precision Tune Auto Care.
Meanwhile, the owners of Liverpool are considering selling a stake to a consortium of investors led by Amit Bhatia. He is said to be in talks with the Fenway Sports Group about acquiring a minority holding that could value Liverpool at as much as $6 billion. Fenway previously sold a minority stake in Liverpool in 2023.
And Blackstone is unveiling new funds to bring private markets to Main Street investors. This comes ahead of its earnings out tomorrow morning.
And Bloomberg reporter Loukia Gyftopoulou has been covering this story, and she joins us now. I guess the first obvious low-hanging fruit question is, there's been jitters around more retail-oriented funds. Blackstone has not necessarily been immune to that. So what exactly are these funds? How are they set up? And is it kind of different from some of the BDC fears that have been permeating through markets?
So I guess the main difference with the BDCs is that they're not private credit funds. They have a mixture of, they will have all of Blackstone perpetual funds. So the real estate, private credit, private equity, infrastructure, and so there's a number of asset classes. I don't know that anyone can guarantee they will be immune to the pressures if people freak out, but I think it's not a pure private credit play where there are specific fears, and that's the reason why retail investors are heading out.
Fears, freak out. That leads to my next question, which is what kind of redemption limits are they putting on these funds?
So one has a 3% redemption limit, and the other one has a 10% redemption limit. There's one where there's a bigger component of a liquid sleeve from Vanguard and Wellington, where there's more index funds and other securities, and that I think is the lower one. But the other one is called the Blackstone Private Markets Fund, and that has a high redemption limit.
We're also going to hear from Blackstone tomorrow. They're going to be reporting their earnings. Well, what are we expecting, and how big will wealth be contributing to Blackstone, do you think? Because it's been a big push for theirs.
I think it's been significant for them for a while. I don't want to put specific figures right now, but it's been a very big driver of revenues for a few years now. The funds will be small at first, but I think where I would focus is the fact that they're doing it with Vanguard, which is the biggest name in Main Street, and that people trust to bring them good, cheap funds. They're rolling it out with Merrill Lynch just at the start, but I have the sense that it's going to be much wider going forward. So, stay tuned.
All right, Loukia, we certainly will. Thank you so much for joining. That's Bloomberg's Loukia Gyftopoulou. And tune in tomorrow after Blackstone earnings. I'm going to be speaking with Blackstone CEO John Gray at 9 a.m. New York time. That will air on Bloomberg Open Interest after the ECB decision. And that does it for Scarlet and myself on Bloomberg Deals. Stay up to speed even after the show. Subscribe to the Bloomberg Deals newsletter. Coming up next, it's Balance of Power, live from Washington.